Hey, welcome to this edition of Property Investment. Why do people invest in property? And the multiple questions I've had over the years when I'm sitting with people looking at properties and where to invest. Now, when it comes to property investment, it's very simple. There's basically just two major things to look at. One is capital growth, and the other one is rent return. In this video, I will explain to you the difference, some of the pros and cons, and that will give you a good understanding of where to and how to invest in property. So when I talk to clients and when they ask me the questions about investing in property, it's really important to understand the basics that I'm going to go through on the board with you today. Once you've got a good understanding of that, then you can make a decision which way do you want to go. Whether it's capital growth or whether it's rent return, also will be determined by the length of time you have to invest in property. If you're in your 20s, then obviously capital growth over a long period is something that you could look into, but in your later years, you probably want to look at something different. When we look at capital growth, you can either have short-term capital growth or long-term. Short-term means it's properties that you can either develop and sell fairly quickly, or it's properties that you're going to purchase and you're going to sit on it for many years to come. So it's got a longer term view. Now with a longer term view is important to where you're going to buy. That's why location is always the answer when it comes to capital growth. That's why I've met so many people that have bought properties in the wrong locations, and after 5, 10, 15 years they're so frustrated because they didn't see any growth in that property. And if they compare that to the amount of money that I've actually spent over the years, it was more than of a headache than actually a benefit. Now, when it comes to capital growth, you can either renovate and sell, which a lot of people are watching these shows on TV, and it looks so amazing where they buy this property and they can actually do some renovations and sell it for a high profit. The reality though, in today's market with the cost of renovations, not only materials but also in labor and the labor shortage, this becomes a very, very unique opportunity to make money. It's not something for everybody. It's not something that everybody can invest in or have the time and the energy to do or have the know-how or the skills. Plus, if you buy the wrong property and it's costing you too much to renovate, you'll be stuck with that property, you won't be able to sell it, or if you sell it, you'll be sitting with a loss. There are factors that needs to be taken into account when you purchase property and sell property. There's the acquisition costs, but then also the selling costs. At the back end, you've got the selling agents that you need to pay, then you've got capital gains, and there's a tax implication that is involved on that side as well. A lot of people said, I want to be involved in subdivisions, and they want to buy a piece of land, just knock the house down and build 2 or 3 units. Now, we've also through the years looked at all those options. We've worked with hundreds of clients, hundreds of millions of dollars of investments, and discovered that this is not as easy and as simple as it looks. Especially if you look at certain areas where you buy, knock down and build, not only do you have the time delay, because in a subdivision, you've got DA approval, you've got council approvals, then you've got the cost of demolition, and then the time delay to actually build the property. And that could end up taking you 2, 3, 4 years in a process of actually subdividing and selling. And that is a frustration for a lot of people. They get stuck in that, and at the end of the day, they discover the holding costs plus the cost of construction just doesn't give them enough profit in the back end. So when it comes to capital growth, it's not always the best option available. In capital growth, what we do share with people is the fact that you need to look at the zonings that's available. So whether it is a R20, R40, R60, because that will determine on how many dwellings you can actually build on one piece of land. Now, if you're a mom and dad investor with limited capital, then that is going to be very relevant to how much money you can make in the back end of subdivision. Now, one of the best forms of subdivision that I've seen in the last few years is if you can find a property where there's already an existing house on, and that existing house is allocated in that piece of land in such a way that you could actually either knock down the garage or the carport, have a driveway, and then subdivide and have a block at the back as probably one of the best ways for capital growth. Because in a scenario like this, you could purchase the property, spend about $40,000 to $60,000 in the subdivision costs, knock down what is needed, and then at the end of the day, sit with a piece of land that you can sell. And then retain the front property. Now, by retaining the front property and having a rental income, you are in that position where you're actually accumulating properties and actually can build your property portfolio while getting quick capital growth. And doing that would probably take you 6 to 12 months. Versus if you are actually going to subdivide and build, which could take up to 3 to 4 years. So if this is something that you are looking at, it's probably one of the best opportunities, but finding the property is the key. Finding the property in the right area is the key. And that's why we've got a service that we engage with as a buyer's agent, where we can help you actually locate and find the right property and help you actually with subdividing and developing that property for your future. Now, if you do that in 6 to 12 months, obviously you can keep on repeating this process 3, 4, 5, as many times as you'd like, and keep on re-injecting money into your property. But the rent, obviously in this case, is something to consider, because in many cases you'll be sitting with an aged property that would need attention and some repairs and renovations, and the holding cost of that in the long term won't probably give you the best rent return, but you'll have that property growing in value as well, which is something to consider in the long term. Now, when we come to rent return, that is something that really excites me, especially in these days, what's happening. I've heard so many stories in the past of people buying properties that is negatively geared. And negative gearing was the motive of saying, oh, well, we'll negative gear a property because we've got a tax benefit. And now most people have discovered that that tax benefit wasn't so lucrative and exciting as they thought, because the property was just costing them money year on year on year on year with no or low capital growth, because those properties are bought in the wrong areas, probably newly built or out the suburbs of the city, and they didn't achieve the results that they wanted. Now, with a rent return, if you've got a residential property, most residential properties earn between 4 to 6% rent return. In other words, if you've got a property that's worth $500,000, you're most likely going to earn about $500 a week in rent. In WA, the rent is a little bit high at the moment. That's why I say 4 to 6%, which means about $25,000 to $28,000 a year rent return. But then you've got to deduct the rates and taxes, the property management fees, and some costs. Yes, you could possibly negative gear and receive some money back as a tax incentive, but ultimately it's not a very lucrative option. That's why some people decide rather to invest in commercial properties. Because in commercial properties, the exciting thing for the investor is that the tenant takes care of everything. They pay for all the outgoings, the rates and the taxes, the waters and everything, and the rent you receive is basically pure income. And that income can possibly give you a 5 to 7% rent return. But then there's risks of obviously involved with commercial, because where do you buy the commercial property? Which area? Is it retail? Is it manufacturing? Is it warehousing? And there's a lot of information and questions surrounding commercial versus residential. Now, the other option for rent return is where people say, well, we want to invest in multiple or group dwellings. That is student accommodation or accommodation close to hospitals where they can rent the property out on a short-term basis, but you'll have multiple people living in the property. If it's a 4-bedroom home, 4 or 5 different students or different individuals. Now, what makes that attractive is that you're not earning a normal rent per year or per month, but you're actually earning a rent per room. And having rental income per room ultimately gives you a better return. With multi-dwelling and group dwelling, we've seen rent returns of 8, 9, even up to 12%, which is a great way of doing it. The negative to that is obviously having a turnover of individuals that can come and go and managing that property at the back end. The other option that people are looking is Airbnb, which is an exciting thing, but there's also things happening in, as you probably have heard and read lately, regarding the restriction of income. But with Airbnb, it is a really good investment. You'll probably be looking at doubling, if not tripling, the rent return from 4 or 5% up to about 15%. But the negative of Airbnb is the fact that the property is either a holiday home or is a home closer to the city, which could cost more to purchase in the first place. But then it's the management of that property that is an issue. Because obviously you've got people coming and going on a daily or a second or 3 daily basis. And that property needs to be managed. So that eventually, in some instances, is causing some people to have a second job, because they obviously would need to take care of the property, make sure it's clean, make sure there's new bedding and all the negative things that's involved in there. But the rent return is fabulous. It's a lot better than with residential or commercial properties. Now, the exciting thing that I think is one of the best opportunities when it comes to rent return is currently in the NDIS and SDA space. Now, in NDIS and SDA, we know in all of Australia, but specifically in WA, there's a shortage of houses just for normal people. But there's been a shortage, a crisis actually, in the NDIS and SDA space for people that has got disabilities that need somewhere to live. Now, like with my story that I've previously shared with my mother, we could not find any place for her to go, which triggered me to find out if there is another solution. Now, with SDA NDIS, the government knows of this massive shortage, and they have incentivized investors to get involved. And how did they do that? They've actually said that they will provide from $40,000 to $105,000 per person, or they call them participants, per year, depending on their need. If it is low care, it's 40, but it can go up to high care, which is $105,000 a year rental income. Now imagine you've got a property that can house 2 high care participants. It means $210,000 a year of rent. Now yes, NDIS and SDA houses is not just any house that you can purchase for this need. The house needs to comply to their rules, regulations, and specifications to suit the individual. Now, with SDA and NDIS, we found that the best option is to actually build houses suitable for that need. But you can build a house and earn $200,000. Now, let's just look at the numbers. If you build a house with $800,000 or $1 million that can take 2 high care participants, you earn $210,000 a year in income. It is 20 to 23% rent return. Now, there's nothing in the history of Australia that has ever been so good to actually do this. Why do they give so much money is things that we will discuss in the next videos. But the bottom line is, it's a rent return that the government can back for 5, 10, 15, 20 years. Yes, there's up to 20-year lease agreements available for this massive need. Now, when it comes to negative or positive gear, it's a no-brainer. Positive gearing is the way to go. And if you can positive gear, then why not look at one that actually will give you the best return and the best outcome? It does not need to mean, if you've got high rental income, that it is necessarily a worse investment when it comes to capital growth. Because with high rent return, you can actually have a property that also grows in value and actually benefit from both. It's not either or, it can be both. But the importance is to find the right property. That's where we as Perth Grow, and that's why it's called Perth Grow, because we want to help you grow in Perth. So we will help you not only obtain the finance, actually as a buyer's agent, help you find the right property. We will also help you with the whole NDIS and join you with the right builder, the right SDA provider to actually build the right property for this massive need. So looking forward to working with you in the future. Do not hesitate to contact us if you've got any questions, but please feel free to look at all our other videos surrounding this topic. Thank you.